Welcome to the 980s podcast hosted by yours truly, Kevin Thompson, founder and CEO of 980 Capital Group. Thank you guys for joining us. As I always say, subscribe to the channel. As I always say, go and get my book, MLB to CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at info@9icapitalgroup.com. Send us your questions, or you go to the website at www.9icapitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, empower, and engage. And today we're talking about that spooky recession. Are we headed to one? What to expect? And what's coming down the pike with Jerome Powell? You don't want to miss this one. Let's get it. Keaton, if you say his name 3 times, what's going to happen? He's going to appear. And Beetlejuice is now in our midst because we've put ourselves in this situation where we're constantly saying, are we in a recession? Are we headed to a recession? Are we going into a recession? And then boom, all of a sudden it's in your face. Not saying we're in there right now, but the lights are flashing red. Basically, what has happened now is that over the past several weeks, we've been getting economic numbers, CPI, PPI, jobs numbers that have been slowly softening. But all of a sudden, you get a bad jobs number in August, and hopefully I can get this out more quickly than that. But get a bad jobs number, and the next thing you know, it's like, we're in some trouble. With monthly revisions that were worse than expected as well. So, all that to be said, the question remains: are we headed to a recession? So let's just really first talk about what an actual recession is. A recession, by definition, is basically slowing GDP quarter over quarter, slowing to negative 2 quarters of negative GDP. Now, granted, we have had that already. We have had the technical term for recession in past years, but they never called it an actual recession because it was just felt different. Even though we had some slowing GDP based on economic numbers coming out of the pandemic, they didn't call it a recession because we had stronger than expected growth in the employment sector. So we've had stronger than expected growth in other sectors of the economy. So they couldn't say, well, we're technically in a recession. So they changed the academic parameters on that. But understand this: despite economic growth, even though it's been positive, the unemployment trends have started to come down. So the Fed's dual mandate is to do what? Price stability and full employment. What the Fed did was, the Fed said, okay, price stability is our main concern. So we're going to hike interest rates. Nothing wrong with that. They needed to hike interest rates because they have to get prices down. Hiked interest rates, pushed interest rates higher, and that was fine. And they noticed that, well, you know what? Unemployment hasn't moved. So let's keep pushing interest rates up. Unemployment hasn't moved. Let's continue to push interest rates up. But guess what happened? All of a sudden, bang, 4.1 to 4.5% unemployment rate. Now we only have 114,000 jobs created with negative revisions in the previous month. Did we wait too long? We know that unemployment is a lag effect on the economy. We get that. It's a lagging indicator. But what we don't know, and by the way, these past numbers, we had that's the hurricane in Houston, and now you have a hurricane coming in Florida. So you have these two dynamics that are pushing these numbers, giving you slight seasonal revisions. And it's kind of hard to dictate that, well, are we truly in a slowing economy, or do we have some negative externalities that are causing this? But the numbers have been taken in stride, and the first thing you've seen has been a sell-off in equities and massive buying in bonds. So part 2, let's talk about the market reactions. Yield curves typically invert when there's signs of a recession. That's just basically how it's been. It's been a precursor for recessions over the past, out of the last 10 recessions, it's predicted 7 or 8 of them, right? So with that being said, if the yield curve remains inverted, that means that people are expecting a slowing economy. Now, like I said before, if you say his name 3 times, he's going to appear. And we've said this time and time and time again, and eventually you're going to be right. So we've had an inverted yield curve, which means that we have short-term yields that are higher than long-term yields, and people are willing to put money in to sell the short-term rates and buy longer-term rates to keep the yield inverted because they just know that rates are going to change eventually, right? But here's the issue. Now you have a massive change in the curve. People are going to the middle of the curve trying to get those yields. They're selling the front end. They're going to sell the front end, the ones, the treasuries. They're going to sell the treasuries and buy the 2s and the 5s because they want to get the higher rates of yields, knowing that people are going to be buying those same treasuries, or those same bonds. We have treasuries, we have bonds, and we have notes. So with that being said, people are buying the middle of the curve right now, trying to get in there and get some nice juicy yields, and also do what? Get return. Yield down, price up. What means that, hey, I'm not only getting a nice juicy yield, I'm getting a nice little return on this as well, which is boosting my total return. So the bond market has been telling us this for the last couple of weeks, and now finally, boom, it hits the equity markets. The bond market is typically 2 steps ahead of the equity markets, and that's what you're seeing right now with volatility. People are trying to run and rush because now, part 3, the Fed's going to have to come back in and do what? You know what? We're going to have to make some adjustments. We have the interest rates right now that are kind of blowing out. We have yields blowing. We have all the stuff going on. We got to figure this out so we can put some, put some calmness into the bond market. The Fed's going to have to calm the bond market down so they know exactly what's happening. Right now, there's speculation, but there needs to be some guidance from the Fed. Will it be 25 basis points? Will it be 50 basis points? Something's going to have to come out in the next month to calm the bond market so it reduces the volatility. The Fed has a problem. They don't want to be seen as impacting an election. They don't want to be seen as having any type of input on who's going to win the White House. They're walking this tightrope right now. Like I mentioned to you previously, price stability and full employment. Employment hasn't been an issue because it's been rather steady, except for this last employment report, because now they're saying, oh my God, is something broken? So the Fed's gonna have to come into the market and quell the issues that they're feeling right now, especially with the volatility and with unemployment, because they cannot let unemployment get out of control. Now, back to the original question. Are we headed to a recession? I said this and I'll say it again. Don't you say Michael Keaton's name 3 times. No. Don't you say Beetlejuice's name 3 times, because he will appear. And right now it's going to appear because people are fearful of what's coming down the pipe. So if you say, hey, we're headed to a recession, it's on social media, it's on CNBC, it's on Fox, it's on MSNBC, it's on all these different channels. What is the investor going to do? The investor's going to do this. Well, I'm not going to spend as much. I'm going to curtail my spending and put more money in cash. That's what the investor does. That's what the investor hears. And as a business owner, if I know that, guess what I'm going to do? Well, I'm going to cut back my spending as well, because I'm worried about the overall economy. So you have businesses that are not willing to invest. You have investors not willing to spend. And you have other individuals not willing to buy or consume because of the current environment, what you're telling them. It's a self-fulfilling prophecy. It's created by the notion of, if you say something long enough, it's bound to happen. So, to sum this up, Our insight is based on Beetlejuice, saying something time and time again, making it palpable, making it a reality. That's what's going to happen. It's a self-fulfilling prophecy. It's important to understand what a recession means. There may be some unemployment rising. There may be some issues in regards to the growth of our economy. But what we can ill afford as a group of individuals here in the United States, what we can ill afford is rising prices and rising unemployment. We cannot have that. So if we have to have one or the other, we have to get those prices down. We got to get those prices down. It's a sad truth, but we got to get those prices down, because if you have unemployment with rising prices, that's just a bad situation. Unless you have lower employment and higher prices, that means what? Prices are going to have to, prices beget prices, and prices are going to ever rise. But then again, you could also say that, well, then if we have rising employment, that means we have more supply and maybe prices will naturally come down. It's all about economics, my friend. It's all about economics. So my closing thought, are we headed to a recession? Quite possibly, because we say it long enough, it's likely to happen. Will the Fed come in and do something to quell the bond market? Absolutely, they'll do something. We just don't know if it's going to be 25 basis points or 50 basis points. And lastly, is this a self-fulfilling prophecy? Absolutely. Will Jerome Powell do the right thing? Most likely. And will the bond market calm itself down between the 2s and the 5s in regards to the interest rates and the duration there? I would say yes. This is nothing more than a blip, but I wanted to give you guys a little bit of insight on how markets work. Thank you guys for joining us. Like I always say, subscribe to the channel. Like I always say, go and get my book, MLB to CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at info@ninecapitalgroup.com. Send us your questions. You go to the website at www.ninecapitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, and engage. And today we talked about recessions. We talked about markets. We talked about what you need to be looking for in this grand, beautiful tapestry of life. Stay humble, stay safe, my friends. I'll see you again soon.